$2, $3, $5, and $7 over the next 5 years. And after 5 years, dividends are expected to grow at 5% a year. That means in year 6, dividends will be 5% more than they were in year 5, year 7, forever. The cost of capital is 9%. So this term, equity cost of capital, is just one of those ways we can say the discount rate for these dividends is 9%. Terminology for the discount rate when we talk about stocks is often cost of capital, or required rate of return, or expected rate of return for the stock investor. How much should this company sell for? So that is asking for the price, which is the present value of these cash flows. Now, for the first several years, there is no pattern. We are given the dividends directly. So the only way to get the present value of those first 5 years of dividends is to discount each dividend individually using the present value of a stream of cash flows, general stream of cash flows formula. But when we get to this part, notice that is a growing perpetuity. And so we're going to use the dividend in year 6, divide by R minus G, now what I wrote so far is called the terminal value, and it's the value here at year 5. But we need to bring that back to year 0. So therefore, I have to discount that back by 9% over 5 years. Now, if you are using the graphing calculator, a convenient way to do the first 5 cash flows is to use the NPV function and then list the cash flows in periods 1, 2, 3, 4, and 5. And then do the last part, the present value, the terminal value, by itself. And I'll just calculate that right now. So I have 7 times 1.05 divided by 0.04 is the terminal value. And I get a 183.75 as the terminal value. But remember, that is the value as though we were to sell the stock or terminate our ownership of the stock in 5 years. So we have to discount that expected selling price by 5 years. All right, and now let's keep computing things. So we have 9% is the interest rate for the NPV. Enter your cash flows of 1, 2, 3, 5, 7. And then compute NPV. I get 13.0090. And now let's get the present value of the terminal value there. You can either type in exactly what I wrote as a formula, which really isn't very complicated, or you can use your TVM solver to calculate the PV of a lump sum future value. And I get 119.4249. And then add the two pieces together. I get a price of 132.43. And I go back to check if that was an option. And I see there it is indeed an option, and it's answer E. Alright, that was an example of a non-constant growth dividend pattern. which is one of the hardest ones to do, so we'll be doing a lot of those examples. This is another one that's also non-constant growth. The information is just given to us in a little bit of a different way. Instead of directly telling us the dividends for the first several years, it says that it is expected, the keyword there is expected to pay $2 in 1 year, so it's pretty unambiguous that the $2 will be paid in dividends in 1 year. The dividends are expected to grow at 10% for the following 4 years until after the end of year 5. So the next 4 years after year 1 will take us to year 5. So the year 2 dividend will be 2 times 1.1. The year 3 dividend will be 2 times 1.1 squared, because it'll be 10% more than year 2. Year 3 be 2 times 1.1 to the 3. Alright, and so then year 5 will be the last year, because it grows for 4 years past year 1 at 10%. After the end of year 5, dividends will grow at a constant rate of 7%. So pay attention here, that in year 6, the expression, the dividends will grow, always is referring to how much more the dividend this year will be than last year. So I'm putting in 2 times 1.1 to the 4 because this portion is the year 5 dividend, and then I'm multiplying it by 1.07 to get the year 6 dividend. And after this point, we will continue to only grow every year at 7%. So the year 6 dividend could be written like that, and then we would square the 1.07. At that point, I can do my ellipse because the pattern will hold after that forever at 7%. The cost of equity is 11%. Now, the way that I would do this is to just discount all of these first 5 years of stocks individually. Now, some of you may realize this could be an application of the growing annuity formula, and you will get the same answer if you use that. The reason that I prefer not to is that the growing annuity formula is a big formula, and I would just be concerned that you will lose your place. And I think that if you can go a bit more slowly and write things, do it the long way in this instance, it will be to your benefit. Make sure that as you're plugging in all your numbers that you're keeping straight what's a growth rate and what's the discount rate. And again, the term for discount rate in this problem is equity cost of capital. So make sure you realize that the 11% here, this is your R. 7 is your long-term G. Alright, and then what's next is to just break it up again. So I won't write it out, but I will, well, I'll write it out. So you can do the first 5 cash flows this way. Notice that I'm not even calculating what 2 times 1.1 to the exponent is. I'm just letting the calculator. Terminal value will be 2 times 1.1 to the 4 times 1.07 divided by 0.04, because that's 0.11 minus 0.07, and I get a terminal value of 78.32935. But remember that is our projection of the price in 5 years, so we have to discount it. Now, as I'm entering the numbers into my calculator, I'm actually not even using the graphing calculator. I'm explaining how to do it in the graphing calculator because most people use the graphing calculator, and it is easy to write down what to type into the graphing calculator because it is this written out function. 8481, and the present value, the terminal value, will be 46.4847. Add the two together and we get 55.33. We go up to see which option that is, and there it is, option D. So the dividend in year 0 was $4.50. Why did I know that's period 0? Because of the word just paid. So that certainly can't be 1 year from now. So it has to be year 0. And the dividends are expected to grow at a constant rate of 5% per year. So that means the dividend in year 1 will be 4.5 times 1.05. 4.5 times 1.05 squared in year 2. Year 3 will be 4.5 times 1.053. Year 4 will be 4.5 times 1.05 to the 4, and so on, every year, forever. Investors require a rate of return of 12%, so here we're using a different expression for the stock's discount rate than the previous two problems. Again, it means the same thing. When you say requires a return, it's 12%. We want to know what's the price 3 years from today. So always put onto your timeline what it is that you're solving for in the end. We want what's the price in year 3. Now the price in year 3 has to be the present value of all the cash flows that come after year 3. So let's look at what the cash flow is in year 4. It's 4.5 times 1.05 to the 4, and it's constant growth, so therefore we will use the constant growth formula for the present value of a growing perpetuity. So all I'm doing there is the dividend in year 4, R minus G, and that will give us the price of the stock in year 3. We wouldn't need to do anything else to it. So you would recommend just putting that exact equation into your calculator. Which would give you $78.14. And we see there's the answer C. All right, question 4. It's telling us about Iota Corporation is in a declining industry, just paid a dividend of $7.50. So I'll put that on my timeline that the dividend in year 0 was $7.50. Dividends are expected to decrease by 8% a year. So that means the dividend in year 1 will be $7.50 times 1 minus 0.08, or 92% of year 0's dividend. And year 2's dividend will be $7.50 times 1 minus 0.08 squared. So every year's dividend will be 92% of the year's the dividend in the year before. I'll just write one more like this, and you get the idea now that every year will be 92% of the dividend of the year before. you require a rate of return of 10%, so here we have that other way of saying the required rate of, the discount rate is the required rate of return. How much would you pay for a share today? So that means we want to know what's the price. Use a little different color. So we want to know what's the price today. Now the price today, remember, is the present value of all the cash flows that will come after today. We will not use the year 0 dividend when we calculate it. But I wrote it on the timeline because it was my reference to find out what will be the year 1 dividend. The formula for the price of a stock today when you have constant growth is always whatever the year 1 dividend is to give us the price today. So the year 1 dividend, we know from the timeline, is 750 times 1 minus 0.08. The R, the required rate of return or discount rate, is 10%. Now this is really tricky. The formula is R minus G, but G itself is a negative number. So this will actually reduce to 92% of 750 divided by 18%. And we get 38.33. Now the thing besides just how to calculate the answer that's really important about this problem is to recognize that even though the growth rate is negative, the stock price will be positive. And that's because when you own the stock, even though the growth rate is negative, you still have a claim to a future stream of positive cash flows. So sometimes we'll put in as an option 0 to trick you to see if you will think that if the dividends are decreasing every year, then the stock would have to be worthless, and that would not be true at all. Again, what's the current share price? So we're really driving this home here, how to do non-constant growth valuation. The dividends are expected to grow at 40% for the next 2 years, with a falling growth rate leveling off at 10% every year after that. The required rate of return is 13%, and the company just paid a dividend of $1.25. So here's the case where you're not given the year 1 dividend directly. You will need to know what the year 0 dividend is as a reference to find out what the dividend will be in year 4. So the problem tells us that dividends grow at 40% for 2 years, and then dividends will grow at 10%, which means 10% more than what the dividend was the year before. So this is the progression of the dividends. So by the time I get to year 3, we're going to keep to this pattern of just increasing all the dividends at 10%. What's the share price? So we want to know in the end, what's that? Remember, when you calculate the price of year 0, we're going to use all of this to get the value here at year 0. We are not going to use the year 0 dividend when we calculate the PV. So the year 1 dividend is 1.25 times 1.4. Discount that back at 13%. Year 2 dividend, discount that back by 2 years at 13%. And then we have the constant growth phase. So the year 3 dividend will be that expression. We're going to divide that by R minus G. We're going to use the long run growth rate of 10%. Remember, take the present value of it going back 2 years, because again, we want the price today. So this last expression here corresponds with all of these dividends. And that's going to give us the value at year 2, and then we have to bring that back to year 0 so that everything is brought back to year 0. Then we just have to crunch those numbers. So the first part, I'll use the cash flow registry for two numbers, 13%, giving me $3.47, specifically this going out to the fourth digit. And this time I'll do the present value, the terminal value all in one shot here. Give me 70.3527. Add the two pieces together. We get 73.82. And there we see it is B. Alright, now number 6 changes things up on us. Instead of asking for the price of the stock, we want to know what must the market's required rate of return be. Now, we rearranged the constant growth formula to be this, to solve for R. The discount rate, again, the word for discount rate when we talk about stocks can be market's required rate of return. Alright, so let's try to get the different pieces here when we have the constant growth. So the dividends are expected to grow at a constant rate of 8%. So we know G. Stock currently trades at $100, so we know the P. Now let's find D1. Now it doesn't tell us D1 directly, so we need to know our facts about what happens to earnings. It says it pays out 25% of its earnings as dividends, and it just reported an earnings per share of $12. So just clear up what I'm doing at this part. To find D1, let's just write down what we know. We know that D0 is going to be, or D0 was 25% of what the earnings were in year 0. 25% of $12 is $3. But remember, I need D1 in this formula. So the way you would find D1 is to use the growth rate in dividends, add 1 multiplied by D0, and we know that the growth rate is 8%, giving us 324. So I'm going to plug that in here to then give me a dividend yield of 0.0324 plus 0.08, or 0.1124, 11.24%, giving me B. But let me just pause here to go over some more terms. This is called the dividend yield, and the growth rate in the dividends is also the capital gain yield. And then when you add the two together, you get the total return from investing in the stock. Alright, JRN Enterprises just announced that it plans to cut its dividend from $3 to $1.50 per share and use the extra funds to expand operations. Prior to this announcement, JRN's dividends were expected to grow at 4%, and the stock was trading at $25.50. Alright. So since it says that it's going to plan to cut its dividend, that means that originally the dividend was going to be $3 and growing at 4%. So this was the original plan. Now, with the market expectation that this is the plan, the price for the stock is $25.50. Now this implies a certain required rate of return by investors. And we can calculate it by using the formula that we were discussing earlier. So remember this formula here. So we have the dividend in 1 year being $3, the price today being $25.50, and the growth rate being 4%. And we get a return of 15.7647%. All right, now in the second step, now under the new plan, the dividend will be cut in half to $1.50. But because they cut the dividend, they can reinvest. And there's a plan that the dividends will grow at 8% as a result of reinvesting. And so the dividends will grow at 8% every year off of a lower year one dividend forever. We want to know what would be the price under this new plan. Well, we've calculated the return that's being used by investors that they require. So we know to discount at this rate. So in our last step, we use the constant growth formula for dividend discount model, which again is this. We see that the new year one dividend would be $1.50. The required rate of return is evidently 15.76%, but the growth rate is now 8%. So put that into your calculator and you get a new price of $19.32. And we see that that is answer A. All right, moving on to number 8. We have Knox boxes. This question will use the formula for the growth rate. So we're going to be a bit more explicit here in how we calculate a growth rate. And it's a function of how much is retained of the earnings, that is how much is reinvested, times the return on investment. And typically the return on equity is our measure of how much we could expect to get in returns that you claim of the equity holder. All right, so let's when we have a problem like this with lots of information, it's a little helpful just to rewrite everything in your own way. So it just paid a dividend of $4. So again, the key word there is just paid. It can't be year one, it must be year 0. It pays out 40% of its earnings as dividends and expect its return on investment to equal the industry average ROE, which is 12%. So the growth rate would be 40%. Sorry, the growth rate will be 1 minus the payout rate times 12%. So this is a good moment to go over the relationship between the retention rate and the dividend payout rate. They are one minus the other because the total earnings will be split up between additions to retained earnings and dividends. Now this is the growth rate in the first 3 years. Greater than 3 years from now, the growth rate with the same retention rate
will be 8%. So we have to read very carefully here. It says the ROE is projected to be 12% over the next 3 years and then drop to a constant 8% after that. So the growth rate after 3 years will be 4.8%. Okay, so we have the growth rates and the dividends. The required rate of return is 10.8%. Let me just write that here. What should be the price of 1 share of Knoxbox's stock today? Right now would be the time to make our timeline. All right, so this question is very challenging because it's non-constant growth and you have to calculate 2 different growth rates. So let's go one at a time. We know that the dividend in year 0 is 4. I will write that down for reference. We know that dividends will grow at 7.2% every year for 3 years. In the 4th year, the dividends will grow at 4.8% over the year before, and then growth will be maintained at 4.8% every year forever. So then I'll just put my ellipses there, and the discount rate is 10.8%. So this here, put a clear mark around the timeline. So we're going to use this timeline. So year 1 dividend, first dividend, discounting at 10.8%. Year 2 dividend, year 3 dividend, and then we have the constant growth phase here, which are all of these dividends. Find the value as of year 3, and then we'll bring that back to year 0. So the year 4 dividend can be written like this: R minus G. This time we're using the long run growth rate, and bring that back to year 0. So it has to be discounted back 3 periods. So let's do the first 3 parts, first 3 dividends. So you can list that in your cash flow registry, just as I wrote there. Discounted at 10.8%. So the present value of the first 3 dividends is 10.323697, and then we'll do the present value of the terminal value, which is 63.2754. Add the 2 pieces together, and we get 74.51. We scroll up to see that answer, and it's there, A. Alright, that's probably, in my view, the hardest problem we've done so far in this video. Let's do number 9 now. We have Coca-Cola's earnings. Per share. That the year just ended was $1.67. It paid $1.32 in dividends. Now, let me just start writing things down. So the earnings per share in year 0 was $1.67. The dividend in year 0 per share was $1.32. Its return on equity is expected to remain constant at 12%. and the required rate of return on the stock is 6.25%. If the dividend payout rate is expected to remain the same, what should one share of Coca-Cola sell for today? So the thing that we need to know is the price per share today. Now, because the return on equity will stay the same and the retention rate will stay the same, this will be a constant growth problem. But we need to know what the year one dividend is to get and we need to know what the growth rate is. We know that the required rate of return is 6.25%. We want to know what the price is in the end. So we need to find two things. We need the dividend in year one and the growth rate. Well, we'll need to find the growth rate first because the growth rate will tell us what the year one dividend should be. And so to get the growth rate, we're going to use that formula again, retention rate times ROE. Now we can find out what the retention rate is by doing 1 minus the dividend payout rate. Well, the dividend payout rate from the last year was $1.32 over $1.67. And we're going to assume a constant return on equity of 12%. So let me just highlight that. This here is the dividend payout rate, and this whole thing is the retention rate. Alright, so now let's put in 1.32 divided by 1.67 is 0.79. 1 minus that is so we get a retention rate of 20.96% times 12%, which is 2.5150%. And now we have everything we need to find the price. So we're using this formula. Now the year one dividend, by definition, is the year zero dividend times 1 plus the growth rate. We have everything we need for this formula. So the year zero dividend is $1.32. Times 1.02515 divided by 0.0625 minus 0.02515. When I put that into my calculator, I will get $36.23, which is the answer that we see there. B. Alright, let's go to number 10 now. We have Acme Corporation's plans to retain 50% of its net income over the next 3 years. In the fourth year, it will permanently retain 25% of its net income. Its return on reinvested earnings, that is its ROE, is 12%. Earnings per share in the first year is expected to be $3. The required rate of return on the stock is 10%. What should Acme's share price be today? Now, when we see a problem like this with especially retention rates changing, really the only way to really do this is to make a table. So I'm going to make a table of years, and we have the retention rate changing after the third year. So let's track it for up to 4 years, and then everything will become constant after that. Let's write down first the earnings per share. Now we're told that the earnings per share in the first year is expected to be $3. So at least here we're told directly what the earnings per share will be in year 1. We don't have to figure it out based on year 0. The retention rate will be 50% for 3 years. And then after 3 years, it'll be 25%. Now we're going to use the growth rate formula, which will be the retention rate times the ROE. Now the the ROE in this case is 12%. So the growth rate will be 6%, 50% of 12%, 6%, 6%, and then 25% of 12%, so the growth rate will go down by to 3% a year. Let's find out what the dividends will be. So we have the dividend per share, or just, we've always been using the letter D. So since the earnings per share in year 3 and the retention rate is 50%, that means the dividend will be $1.50. So the dividend will be the earnings per share times 1 minus the retention rate, because the dividend payout rate has to be 1 minus the retention rate. And we can find the dividend in year 2 by growing the dividend in the previous year by 6%, and then by another 6%. Now in the 4th year, 25% of the earnings will be retained, and that means 75% of the earnings will be paid out as a dividend. The difficulty with finding this one off of the previous year's dividend is that we're going to have this change in the retention rate. So I'm going to also fill in the earnings per share. So the dividends and the earnings per share will keep growing at the same rate. So the earnings per share will also be growing at 6%, and the earnings per share in this last year will be 6%, because the 4th year dividend will be a function of what the retention was from the previous year. So in the previous year they retained 50% of the earnings, which generated a 6% return for year 4. However, starting in year 4, they will not be they won't be retaining as much and paying more as a dividend. So the dividend, sorry, I forgot to put the exponents there. The dividend in year 4 will be 75% of what those earnings will be in year 4. And then the growth will be a constant 3% after this point. Well, let's I think instead of moving the formulas down to the timeline, I think in this instance it will help us if we can just write down what all the dividends are precisely. So we got $1.59 being the year 2 dividend. We have $1.68, 54 being the year 3 dividend, and then the year 4 dividend, which we had to calculate off of the earnings. 1.06 raised to the 3 times 0.75 and we get 2.679786. I'm including a lot of places past the decimal point because I really don't want to lose precision. It might be a bit overkill, but that's what I want to do. Alright, but now we have the dividends for our timeline. The rest, by this point, is relatively easy. So we have the year 1 dividend, $1.50, year 2 dividend, $1.59, year 3 dividend, $1.6854, the year 4 dividend being 2.679786, and the year 5 dividend is 3% more than that, and the dividends will keep growing at 3% after this point. In fact, yeah, and we're going to calculate the present value based on a required rate of return of 10%. So the price is $1.50 over 1.1 plus 1.59 divided by 1.1 squared plus 1.6854 divided by 1.1 cubed plus 2.679786, the year 4 dividend. Now at this point, dividends are growing at this constant rate of 3%, so we can use the growing perpetuity formula, but it would be giving us the value at year 3. So we're going to discount that back by 3 periods. Alright, so we know this is a bad problem that we have to go over to the next line. And let's compute all that. To calculate the present value of the first 3 dividends first. I get 3.94395 using my cash flow registry. And let's get the present value of the terminal value. So we have the 2.68 cents divided by 0.07, and then discount that back by 3 periods at 10%, which is $28.76 and a fraction. Add the two together and we get $32.71. And we go select the answer and we see that it's there. This problem, this building supplies problem, it's a little tricky. And so when you have problems like this, let's just go slowly. And we see that it has earnings per share of $3. It had, so that means the year that just passed, so I'll make that year 0. It retains all of its earnings, allow its earnings to grow at 12%. So the growth rate is 12%, which means that the earnings in year 1 will be 12% more. And it's not until after the 3rd year of earnings that it will retain only 50%. Right, so 12% the next year. Right, so we have 12% every year because they're retaining everything. The 3rd year, all the earnings are retained, so that 12% growth will mean that the earnings in year 4 will be 12% more than the earnings in year 3. Now, what they do with the current year earnings is retain all of it. So they've been retaining everything and will retain everything for 3 years. However, in the fourth year and on, they'll be retaining only 50%. The implication of retaining only 50% is that they can only grow at 6%, which would then affect year 5. So year 5's dividend will be 3 times 1.12 to the 4 times 1.06. Right, now that we understand the earnings per share, the growth rates, retention rate, now we can calculate what the dividend is every year. So no dividends for 3 years because they've been retaining everything. In the fourth year, they're retaining 50% of what the earnings were. So the earnings in the fourth year will be $3 times 1.12 to the 4, and now 50% of that will be paid out. Because they're paying out some of it, in the following year, the dividend will only be 6% of what it was in year 4. Now, on the timeline, it will look like this. No dividends for 3 years. In year 4, the dividend will be half of what the earnings per share were in year 4. And in year 5, that year 4 dividends will grow at 6% and then keep growing at 6% after that. So we have constant growth of 6% of these dividends. So if we apply the growing perpetuity formula, it will give us the value at year 3, and then we would discount it back to get the value at year 0, applying the 8% required rate of return. So let's calculate the price. So we're going to use this year 4 dividend divide by R minus G. We're going to use the new constant growth rate here from that point on. It's giving us the value at year 3, so we discount back by 3 periods. Now just to break down things for you, this is telling us that the dividend in 4 years will be $2.36. Divide that by 0.02. So we'll have 118.01395 divided by 1.083. So we're projecting the stock price to be $118 in 3 years. The value of that today would be $93.68. And we get the answer A.